fade out. Oh, look at that hat.
Yeah, I am literally, as soon as we're done here, I am walking down the Swan River to the Optus Stadium for the first day of the Ashes, which will mean precisely nothing to 90% of people.
You should explain that.
It's England versus Australia at the cricket in Perth, and I'm speaking from my hotel room here in Perth. Got 30 lads loitering downstairs, ready to walk over to the stadium.
That's fun. That's fun.
How could we not talk about the market?
Well, one of these days you'll have to explain to me the rules.
I've got 2 days straight of the Ashes, but this market certainly got me hyped up into that.
Well, it's interesting because yesterday into this thing, the NVIDIA print or whatever, and then Walmart this morning, people forget about Walmart, which was up 5% in the pre-market.
Yeah, was the only green spot in the S&P, right?
Well, as a guy who's owned staples for a while, I think defensives, the healthcare names and the staples have, even if, they all have some warts on them, but I think the defensives are just super underowned, and they were funding currencies, if you will, or funding equities. And as people get out of the winners that have been really good to them, they cover the funding, what they're funding with. And
help me with that. Just pause for that. I mean, I do think that people have been hiding in the staples for a lot longer than you'd suggest. I think, yes, in core long short world, I think listen,
no way.
These names would not be trading at them. These multiples, they wouldn't be trading at the multiples if they were if they were net for sale.
No, you're wrong. They traded those multiples because they're okay, let's use Clorox as an example, because I had a buddy who's kind of a value investor type guy come to me. I have a group with guys, and a lot of them are fund managers in the group, and we all bullshit with each other. And he's like, I like Clorox here, right? And I looked at it. I spent 20 minutes looking at it. That's $600-800 million of free cash flow for 25 years. Okay, yeah, it's not growing. It is what it is. But people need to clean their stuff. Forget about that COVID period where people got a little too excited to clean, and you had a little over earning period, and the stock got a little ahead of itself. But
a few drinkers.
Yeah, that level of stability is worthwhile. Bonds, regulated utilities. The IPPs now with this whole LLM thing are kind of in.
Yeah,
they have a beta component to that.
I was just bemoaning. Listen, I'm a closet uranium bull, and it's just they've been punished. Uranium miners been punished more aggressively than neo clouds this week. I mean, it's just been the last since the market turned with the Bitcoin break in early October, the uranium miners have traded worse than the Nebiuses and CoreWeaves of this world, frankly. Horrendous.
Yeah, but I think it's the same thing. I mean, if we go back since 22, you think about 22, and I was just on the phone with somebody. You had the triple yazoo of tightening, which was the U.S. deficit went from $3 trillion to $1.2. Oil went from, I don't know, man, negative at some point in 2020, but from non-existent to $130 at the peak, $120, huge squeeze. And then dollar rips because rates go from, again, kind of like oil, non-existent to, oh, hey, by the way, we're going to do consecutive 75 basis point hikes. But the NGDP of the U.S. economy was double digits during that period, right? People had just had this 2-year period of savings, and government gave them some money. Plus, they gave them a 2-year wild bull market, and people made some money there. And they'd been locked in their house like a bunch of hamsters, so they went out and spent some money. And so the difference now is that the economy is actually not strong anymore. Plus, you have the government doing the exact opposite, which is the tariffs are contractionary, right? 1% plus of GDP tax. The student loan collection is not growth positive, right? There's going to be 100 billion-ish of new collections. Plus, it amplifies it. Putting BNPL onto people's credit scores kind of lowers the capacity of that, or the attractiveness of it, if you will. And I don't need to keep going on, but the point is that fiscal stimulus, the impulse is essentially gone away. And now you got the Fed. And look, I don't know. Your guess is as good as mine. I don't know why Jay Powell.
Listen, it feels like, I mean, we didn't mention this jobs print. I mean, this very old, stale jobs print today. But, you know, it strikes me it's probably irrelevant, right? They're not going to get classic evidence data points to permit or permission the cut unless something shits the bed between now and the meeting. And the question is whether or not it's a massive equity drawdown, or does plumbing get unstuck in the short-term interest rate markets? I don't think we're seeing any huge. I mean, we're seeing suggestions, but nothing breakage wise yet. But I think, but do we? I mean, ultimately, what's the permission structure for the easing for the next meeting?
Well, I'll tell you, and I've kind of said this for a bit, is we're back in the Q4 18 playbook, basically, which is, hey, okay, you don't think look, I don't know why, and I said this on a million conversations about this after that Fed meeting in the end of October, and they're like, we're not going to cut in December. It's like, what are they talking about? Like, rates are way too high right now. It's been super annoying to me because I've been a SOFR bull the whole year, and just so everyone knows, like, SOFR is not euro dollars. If this was euro dollar or LIBOR world, we would be much lower because that unsecured credit component can bully the Fed. That's why they switched over to SOFR, which is like the average repo rate for 91 days over the quarter, because they're in control of monetary policy now, not the European banks or the Japanese banks or
or the
whatever.
Medicis, Ben, or the Medicis,
or whoever. But the point is that they can control rates where they want. And so what's going to get them to change? Well, this is a very non-normal time. I don't think there's anybody in the markets who've seen a Fed and a president go at it publicly like this. This guy's on his way out. The Fed could be pissed that that this guy's trying to challenge the independence of the institution and their power structure. And this is a way. Look, if the S&P goes down 30%, 20%. It's going to be a hard political.
They have to cut because, as a number of people are saying, Cuppy said it for a long time. The stock market drives the economy now, right? And so if we do get a 20% correction in asset prices, they have to cut, and they have to cut aggressively.
Yep, that's right. It's become financialized. Like in the old days, it was industry needed capital, and finance was there to serve industry. And now industry is just kind of like a narrative or whatever, but it's really just about, and as a volatility guy, it's great because, there's a lot of fundamental guys from the old school that we were trained in still kind of operating in that model. And they don't realize that, like, wait, why was my stock down this and there's no news? I was like, because that's not how the market works anymore, buddy. Like, fundamentals will win out over time without question. There's a reason why JP Morgan and NVIDIA are sitting at the highs. Forget about the fluff.
Listen. Actually, let's do that now. You've been gunning after the money center banks for quite a while now, Ben, and let's just
unsuccessfully. I just want to let people know unsuccessfully.
I think your thesis is pretty good. The question is, what are the catalysts now to make that trade work? I was really taken by your convex idea in just the XLF ratio back spreads that we talked about yesterday. I think that could really work short term. But let's think about what the sort of the dominoes are to get that financial short working.
So I was on the phone right before this with my partner at Wall Street Beats, Charlie Peabody, who's the founder of Portales Partners. He knows all the big short guys. He's been a bank analyst on the street for 40 plus years, right? And we were talking about it because he's been in the trade also. And, the idea is that people have this bullish view on capital markets. And I don't think they appreciate how quickly the rates component can go up on them. And so maybe the next leg to get these things down, they have a big conference coming up a week or two, is they talk down the capital markets.
It's the big Goldman, right? And
Yeah.
last year, do you remember this time last year? All of the banks were coming out saying it's the golden age of M&A and capital markets. We're going to make so much money in the next 2 years with this bonfire of regulations, etc. And all of the M&A boutiques tacked on 40% of market caps over the next 2.5, 3 months. Now, I mean, I got this trade horribly wrong. I sort of pressed them at the lows in Liberation Day when I thought, you know what, chief executives are going to be sitting on their hands. There's no way they're hitting the button on M&A right now. They're just going to be focused on buying back stock all year. Actually, in terms of capital markets and M&A deal volumes, these guys have really done very little. The only M&A activity has been grift activity, frankly. And that's not the kind of activity where M&A advisors, white shoe advisors get paid. But the stocks haven't given a fuck. They've just carried on, driving up against me. I think there will be. I've been really reluctant to take that trade off because, the show me moments in terms of deal volumes just haven't appeared. And the biggest source of deal volume for these guys is the private asset world, the private equity, private credit complex, which has been paying, 50% of their fees now. And those guys, are not getting new inflows, and actually they're dealing with sort of stemming outflow type problems right now. So, I think, actually that Goldman conference could be a really interesting catalyst.
Yeah, and just think about what a bank does, right? Like you've worked at banks your whole career, right? You were a successful bank guy. You were maybe to the managing director level at numerous major banks. You do M&A, that's true, but it's not a high multiple business because it's clustered, right? Like, hey, it's a movie.
Well, you've got to pay all the bankers. You've got to pay the bankers most of the fees.
And that, right? It's kind of like the NBA or the NFL, or some major league, the Premier League. Like half the fees have to go to your talent. Then you have the better business, which is trading business and lending business. Okay, so you're in spread businesses, right? So what happens as volatility continues to come in structurally? Like even now, volatility. I mean, the second month VIX future is like 23. It's whatever. It's whatever. But the trend has been down. Bitcoin volatility, as an example, Bitcoin has been trending down. And let's just say the rates on the short end, maybe it's that Jay Powell isn't trying to screw Trump, maybe not. But maybe it's that he's trying to protect the banks, because the faster they cut that, the less income. It's going to hurt their net interest income, right? And I don't know, because they make it incredibly difficult to figure out the mispricing of duration gap. So, does interest rates going down help you or hurt you? Because it could be, either side. I'll give you an example. Palantir is hurt by interest rates going down. They have like $6 or $7 billion of cash. They have like no fixed rate liability, no liabilities. So that every 100 basis points is going to hit their net income, independent of their other business. That's a simple example.
So their multiple would go from idiotic to super idiotic.
No,
it doesn't really matter.
I'm just making that so I don't get into too esoteric of a conversation about
duration. But actually, I just wanted to come back to you. I mean, on the spread business between in the big banks, it's really important not to think about them like the commercial banks of old, where they were borrowing money at deposit rates and lending long and capturing spread that way. So much of their lending activity is in the prime finance world. It's sort of, it's compressed into the front of the curve. I mean, the traditional sort of borrow short, lend long thing is not really there for them in the same scale as it was, generations before. But, listen, at the margin, fixed income volatility going up compresses spread business activity. Has to. People get slowed down by the risk managers when things like that are happening. But what triggers a spike back up in rate volatility? And actually, just before on that, on your point about the VIX, 23 is a funny number in VIX because it's kind of like a stepping stone number, right? You hang around at 23 for long enough. I saw a really interesting histogram the other day of time spent in various zip codes of the front of the VIX curve, and in terms of literally specifically that number 23, it's often the stepping stone to a much higher number, right? You don't want to hang out on 23 for too long.
Well, no, the VIX itself, like the front, the spot VIX is weird because it's a non-traded product, right? So, it's always like, and it can also be manipulated by the skew and the puts and the calls. So, like, I don't really, think about it that much. I'm much more interested in the implied in the markets, 25 deltas and what the actual traded futures are. But like if we look at the spot VIX, I guess it's 26, okay? And so you don't want to be in there when it goes from the 23, 25 to the next level. Because that's when they start selling most assets, basically. That's when like the risk models, which are prevalent now on the street, say, hey, we have to degross. And then, I mean, I on one of my Bloomberg chats, somebody today said that the vol targeting guys sold like 13, 15 billion today. And I know the CTAs are selling, right? So the systematic guys drive their whole model off of realized vol, and they all have their own little thing, but that more or less vol kind of drives their leverage and their allocation. So what you're saying,
so just on that, we've got we've got a decent size OPEX tomorrow, right? Do you think we can calm down from here, right? As a couple of people have pointed out to me today, this is the kind of day where the guy that never looks at the market gives you a call and says, what the fuck's going on? And today was definitely one of those days because, the headlines yesterday is all is good in AI bubble land and everyone sold the news, right? And the question is, I mean, we've got sort of a bunch of systematic and artificial flows that are going to drive volumes tomorrow, right? And pricing tomorrow. If we can get through that relatively unscathed, is there a chance that we can sort of settle down a bit next week? I guess is the question.
Totally. And I also don't expect this to be like a vol. Like I don't expect this to become like the spring, basically.
Yeah.
And even like go back to the spring here. Let's like go back to this chart real quick and talk about this because it's funny because sometimes things kind of work in a funny manner where they repeat. And let's hit share real quick. All right, share screen, Bloomberg. Here we go. Share. All right. And then we'll go add to stage.
There we go.
Or
it works.
There we go. Like this. So this is 1 month implied versus realized correlation, right? Which is kind of the output of the differential between single stock vol and market vol.
Just go through what's red, black, and purple, just so that people know.
The red is the 1 month realized correlation. The black is the 1 month implied correlation, and which is so the dealer price is black, the actual realized is red, right?
Yeah.
And then the purple. I think my buddy Mike Green, we were talking about some stuff. This is the S&P 500 high beta divided by low vol. Okay. So what you can see here is when implied correlation is going up, because we can have a period where we've had very high single stock vol for a while, right? Like,
it's the cornerstone of the dispersion trade, which is the biggest trade in vol land, right?
Right, but even just like I think it's a function of the passive that there's half the market's not actually active participants anymore. And then you got these other guys who are vol targeting CCA systematic guys. They don't look at an earnings and be like, oh, that's an overreaction or underreaction. And so you just have not the liquidity we used to have, and the vol is much higher just from a mechanical standpoint. And then you have this concept of the dispersion trade, as you talked about, where guys are buying the single stock vol and shorting the index vol. And what you can see on this chart is in February, they had taken that down to zero. And you can kind of think of this as the amount of leverage in the system. So when you take that down to zero, there's a lot of leverage built up. And then this is a deleveraging, which is why low volatility is going to outperform high beta. And then in a re-leveraging, like we've had since April, you're going to see high beta crush low vol, and you're going to see this number come down. And then it's ironic because we saw this like level here that we saw in February, and then we just saw it, and then it jumped up off the bottom, right? And this realized correlation like jumped up, and then we kind of had this weird transition period the last month or so. And I think it was like October 9th, we had the 4% down day in the Qs. Then we had the big Meg 7 earnings days. Then Jake Powell comes out and is like, hey, I'm a cowboy. We ain't cutting. And then it just kind of, and remember, in September, we had all that credit stuff and Jeffries was getting hit. So it's just kind of built on itself. And so now you see this like black line, which is the implied correlation, rising. You see what happened there. So the question will be, does it broaden out into all vol, or does it stay this thing where, again, to go back to NVIDIA and JP Morgan, I think people who are listening, focus on those two stocks. Because even though NVIDIA gave up all its gains from overnight, it's still at 180, or that's where it closed. And JP Morgan's at 298, 300. Like, those things are at the highs. Forget about the fluff move they made after that. Like, if NVIDIA breaks the 180, 175 level, or JP Morgan breaks the 290, 295, then you know that this will actually, there'll be more vol. This thing will take to the next level. You know what I mean? If they hang in there, those two generals, you know, maybe we're just cutting fat out, and there was just a shitload of excess, the Oklos of the world. I mean, just, you know, there's just a lot of air that needs to be taken out. And so who knows? Like, my view is that they're going to try and force the Fed to cut, but maybe not. Maybe it's just a repricing, deleveraging and repricing of all this wildly speculative stuff. And we'll see. I just think watching those two generals, the power, the size of the market, and if they break, then you get bigger, basically.
Yeah, I said so.
Or bigger on the short side. I mean, sorry.
Yeah, I knew you meant. I think the equity market does have the power to force the Fed's hand, right? I think it'd be helpful to look at what else is going on cross asset, right? I mean, is this? I mean, I know that you're salivating now about, you know, the dollar move finally happening, right? And I'm wondering what you think. I mean, the obvious thing is you know, Japanese rates, right? I mean, and you know, really, it's the yen that's leading the bleed in, you know, non-US dollar fiat right now. What causes that to broaden out for sterling to come under attack? The euro, your hated fiat, the euro. What causes things to broaden out, right?
I mean, look, I think you'll see these.
Apart from your position, apart from your book, what causes this to broaden out, Ben?
I don't know why. Look, I don't want to get too deep into my theory, but like, I don't know why the ECB is sitting there lying to people in essence and trying to keep this, other than maybe keep capital there. But like, the Swiss bank's about to take rates negative. You know, you have China bringing more and more volumes all over the world in larger volumes at lower prices. So that's deflationary. UK economy is not very good. I guess they're still kind of doing that thing that central banks do where they're looking backwards and they're seeing inflation. But remember, again, the summer of 2008, go back to it, 5-6% inflation in the US. If you read the long transcripts, which are the 5-year delayed transcripts that the Fed, you get the whole transcript, everything that was said, presentation. In August of 2008, they were, one of the options was to raise 25 basis points. Because you know what? That's what everyone was talking about.
And Trichet did in Europe. Right.
Yeah, exactly. And so I don't know. Obviously, I'm an outside observer, but I think the euro is what you want to watch in FX land. Like when that cracks, if I don't know, my assumption is it will, but if
Yeah,
that cracks, that's when the dollar
okay,
will really.
okay, so what
Let me take this
causes
off.
cracks? What causes cracks? That's what I'm more focused on, right? I'm more focused on possible catalysts, right? Because we all look at these charts and we can, you know, we can see, you know, a dollar that's been basing over the summer. I obviously called it out and called it the little mutt that wouldn't do more than a whimper in my weekend note, which obviously caused a two big figure rally straight in my face this week. I mean, you listen, that's it's the bias of where I'm positioned. Is I've got a sort of negative US dollar bias to my portfolio, but I'm hedged, right? I've got, the hedge book, which is in euro and in yen pairs. It's done very well this week, and more than sort of
Look. Let me
stem
stop
the
you.
bleed.
Let me stop you. Basically, pre-tariff, everybody spewed dollars out in the world to get as many goods as they could before they had to pay a tariff. That weakened the dollar. Then the whole world was overweight dollars, unhedged, like a bunch of carry pigs that Rupert and I don't like. And then all of a sudden they're like, "Wait, what's going on? I'm getting hit both in the asset side and the FX side." Then they all kind of at once realize, and I could show you this. Realize that, hey, I got to hedge my book. And, I think I showed this the other day, but I'll just show it one more time real quick.
Yeah, I think we did.
Yeah,
we'll put it in the show notes. We'll put it in the show notes because we've only got a couple more minutes.
But basically, hedging demand came in. And so I think it's just unwinding. Those hedges got expensive. Now the dollar's starting to work against everything. And then basically the dollars are starting to come home. And then you kind of have a global deleveraging going on. And then that will just lead to deflation. And so it's not going to matter. It's like a connected global world. I mean, China has the most deflation of anyone, and it just spews out essentially. And so this is inevitable. And so it's just really like the relative rate of change. But my view is in the deleveraging dollars, because most of the debt is dollar denominated. It doesn't mean it's sustainable, but in the short term, the dollar gets the appreciation. So let me ask one.
Be careful. I just be careful. The sweeping statement: all debt is denominated in dollars.
No, I said most.
Yeah. I know, but there's that majority has been waning, and that rate of change on the waning has accelerated in the last 3 to 4 years. You're seeing all sorts of things going on in EM with African countries swapping their dollar debt for RMB. You're seeing also at the margin, it is changing. So
let me say one more thing. I talked to a guy at one of the major institutions of the world, money manager. He just spent 10 days in Asia, and he said, if you think that the rest of the world's not going to continue to buy U.S. assets, you're crazy. And he's like, it's massively bond bullish because you know what? Pensions, endowments are starting to switch into bonds, and people still want U.S. assets. So like that whole idea of people not allocating to the U.S., I think it's going to be shown to be like, hey, yeah, maybe like there was some money that could go other places. But like, let's see if the dollar goes back to 110 or the DXY 110. Let's just see how like that Greek stock market holds up. Or, I'm short the EWY. Let's see how that thing hangs in there if tech starts to go down. And, the Korean won was down 120 bips today. So we'll see. I know it's hard for you, buddy. You can't be a dollar bull. Last thing, let's talk about Bitcoin for a second, and then let's get out of here. We don't want to keep people too much. The Bitcoin obviously led, and on this, similar to the spring or the spring, right? Like Bitcoin led the queues back then as well. To go back to like the parallel, and so the question is, is a move from 125 to 86? That's a pretty
It's huge.
6 weeks
huge.
On a $2 trillion asset? Like that's an enormous move.
Well, I mean, so I saw an analysis of basically the break-even price of the average IBIT holder, right? The average, if you just look at the fund flows into IBIT versus price, the iShares BTC spot ETF. Basically, this move has put the average holder of IBIT underwater, right? And I don't think it can afford to stay there very long.
I think that's right, actually. I think that like basically
Everyone's so obsessed with Saylor and his ridiculous MicroStrategy product, but actually the asset that really matters in this sort of neutering of Bitcoin that has occurred over the last 2 years are the spot ETFs. And you really want to watch what the average break-even price for newbies in that market. You know, your average RIA that added a little bit of spice, maybe we'll put a 1.5% position in IBIT to, you know, get our more curious clients off our back and say that we're participating in the modern world of finance. Well, you know, that trade on average just went sour this week, and I think that's significant.
Yeah, I think that's right. On chain, there's still majority are still in money, but I think the new money is the ones who are like the ETF guys that came in since the IPO in January 24.
The whole institutionalization narrative is the one that we need to watch for now, right?
Yeah, 100%. And like, look, you know, I'm a volatility trader, and like I have guys who just kind of deal in that, like their core business is just because there's so much vol there. I mean, there's a lot of things to do in these equities, or you know, in IBIT, ETF. Like, there's a lot of stuff to do from a banking, trading, sales and trading perspective. I mean, even this summer, look at all the you were an ECM captain, like bullish and BMNR and like all these treasury, these Bitcoin treasury, Ethereum treasury, like that's new fees, right? So they brought a bunch of new product that has a bunch of vol, gets guys to transact. And so there is a totally new component. Now vol is a institutionally traded thing, whereas before you had to go to Deribit, and this is my old Bitcoin day or crypto days, and like that's not where you wanted to trade vol. Let me just tell you. And so you basically have this situation where the vol is going to suppress it, and you don't. I think you lost some of the convexity in this thing.
Oh, I listen. I wrote a piece almost a year ago. This today, which was, you know, it was called the last table at the Wall Street Casino, which was just all about this institutionalization and effective neutering of Bitcoin first, then Ethereum as asset classes. You know. It got smothered and killed with love. Anyway, Benny, I have got a very important
one last thing. I just think you got to remember that Bitcoin. I know Bitcoin is a very high beta to liquidity asset. It leads. It gives you a leading signal, and you know the other stuff that has high beta to liquidity, aka leverage, the spec stocks, the Oklos of the world, they're trading like Bitcoin. And so it's kind of telling you that we have a leverage liquidity suck going on. So if you're a bull, let me leave everybody with this. Who's going to buy? The professional managers are looking at their bonuses potentially evaporating. They're going to close their books as much as they can. They're not going to be like, hey, I'm going to defend this. You have retail probably all of a sudden realizing like, wait, is the bull, you know, maybe today was like the official start of the bear market. You got vol too high for the vol sellers, and then the systematic guys have to take their leverage down. So I think that like the market mechanics slowly have changed, and then usually in stocks, you either are going up or you're going down. When you go sideways, whether you've been on the floor for a while or you're at the top for a while, you're getting ready to change directions. And that's what I would leave people with.
Trend shift.
Love your hat, buddy.
We're going to need it.
And this is a company I'm invested in, Einstein Energy. It's a smart bar. It's going to be great.
This is my stepson's cricket club in Melbourne. I am not invested. So, buddy, we will catch up again on Sunday night. Hopefully, I will have a huge smile on my face as England has gone 1-up against Australia in the Ashes. Until then, amigo.
It's fun times. I'm glad we're in the mix, buddy.
Fun times.
Enjoy the cricket. Maybe on Sunday you can teach me the rules.
It won't take long.
All right, bye.
All right, buddy. Take care.